Hello everyone, welcome to Oliveboard. This is the Sure Short Topic discussion series in which we are discussing the most important topics. So each and every session in this series is very important for your exam point of view, and definitely these topics will help you increase and score more marks in your May 2025 exam cycle. So today we are discussing the delivery models, which is a topic from module C of your Retail Banking and Wealth Management paper. This is lecture 12. All the previous lectures are very important, so make sure that you watch them, like the video, share the video, and subscribe to the channel so that you do not miss any of these important sessions. So now let us start with the delivery models. In the introduction of retail banking, we have made it clear that there is multiple delivery channels in the retail banking model. We have the physical channels as well as the remote channels. Then we also have the electronic channels like ATM, net banking, mobile banking. But here we are going to focus on the cases of the physical channels, in which we have the branches, we have direct marketing. Basically, we can divide these channels into two categories: branch and beyond branch. Branch refers to the branch staff, which are also known as the internal customers, and then we have the D direct marketing managers who also stay at the branches. Both of these are present at the branches. Then we have the beyond branch model where we appoint the direct selling associates or the direct selling agents, right? So the human interventions in the physical channels are the internal customer, the specialized marketing personnel, and the direct selling agents. Let us study about each of these physical human interventions one by one. So first we have the internal customers, that is the staff at the branch level. The staff members of the branch, they play a very crucial role in the entire delivery process. They're responsible for the end-to-end service delivery, and any deficiency on their part will result in the customer dissatisfaction. All right. So internal customer is more focused on the service delivery. If we talk about the public sector banks, even without a strategic focus to retail banking in many banks, still the service delivery is generally more personalized because of these staff at the branch level, which are the internal customers. So there are certain characteristics and traits which the staff should possess. They should have a good understanding of the customer, the income level, financial profile, needs, requirements, and the life stage. They should have correct understanding of cross selling so that they can cross sell the right products to match their requirements. They should also take on the post sales service follow up. They should have customer empathy, that is, putting yourself in the shoes of the customers, a better understanding. Try to understand the situation of the customer. Apart from this, understanding of the product is also important. If the staff do not themselves understand the features and characteristics of the product, how will they explain it to their customers? So, understanding of the product for the right selling, better product and service delivery is very important, and the attitude for customer service and the concept of team in customer delivery. Right? So, these are the essentials of the staff, and it would definitely result in better realization of retail banking, right? So first at the branch level we have the staff, then we have the dedicated marketing managers, or who are also known as the specialized marketing personnel. Earlier there was an integrated approach to retail banking. Banks have now started building a standalone franchisee, and specialists are appointed to carry on or carry out the banking marketing initiatives. Why? Because in foreign banks and in private banks, there was a mismatch in the objectives and human resources available. So they needed these dedicated marketing managers. Even public sector banks have redesigned their marketing approach, and they're appointing the specialist officers. So separate verticals for marketing were set up and the dedicated marketing managers were appointed. These specialists are known as the marketing managers who have a MBA in marketing. They are young, energetic, and recruited from the campuses of management schools. So they already have experience and education. They have the educational background as the marketing managers. Some banks appoint them in the junior management, some in the middle management. The compensation structures are also very attractive. Both fixed and variable components are there. That is why they also wish to work in the banking segment, right? So, what are the expectations from these marketing managers? They should have the correct market intelligence, potential sourcing, product and service delivery presentations, right selling, sales conversion, compliance, following up with the operations, and customer relationship management. So, these officers were given the dedicated assignments for better and focused marketing approach. Thus, the conversion leads and service delivery quality were better achieved. Right? So, this was the main aim and benefit of appointing the dedicated marketing managers in banks. These were the physical interventions at the branch level. Now, beyond branch, those who are not present in the branch but are appointed by the banks are known as the direct selling agents. The concept has pioneered by the foreign banks and also by the private sector banks. These are agencies appointed by the banks to source business for them on a fee basis. So the direct selling agents will contact the customer. They will explain the product to them. They will basically market the product. Banks who do not have a branch penetration and geography, they seek help of the DSAs. That is why foreign banks and private sector banks, the DSAs are more popular among the foreign and the private sector banks, right? So they will make the tasks easier for the banks for the marketing. DSAs are primarily engaged in sourcing credit cards and retail loans. All right. So marketing of credit cards and retail loans. However, the appointed DSA agency will appoint the field personnel and supplemented by the telecallers, they will start the marketing process and the follow up. But the scrutiny and the KYC formalities have to be done by the banks before offering the same to the customers. The scrutiny and the KYC will be done by the bank. This responsibility will not be given to the DSA. Why? Because mis-selling by DSAs is rampant, especially in the credit card space. The employees of the agency, they mis-sell the credit card products and make the customers fall into a debt trap by misusing the cards. Similarly, retail loans are also mis-sell. The pricing for the loan is not explained clearly. The charges, finance charge, interest, how it will be calculated. This will result in dissatisfaction for the customers and reputation risk. The reputation of the bank will go down in the market. All right, so that is why banks, they have to conduct their own scrutiny, KYC, and the identification of the customers. All right, despite the lack of loyalty and accountability associated with the DSAs, still the new generation private banks, they see this as the only way for growing their scale of operations. In the case of large private player whose more than 50% of the assets are sourced from the retail side, DSAs play a vital role, mobilizing 70% of the asset portfolio, right? And because of DSAs, the private banks were able to achieve the doorstep banking. All right. And the compensation is also dependent on the volume of the business sourced. So that is why there's always a risk attached with their kind of selling. This risk is the reputation risk. It is always a threatening factor in the DSA model because they want to source more business that will give them more compensation. So they will make false promises in the turnaround time. in the issue of credit cards and the asset processing, right? So it would affect the bank and not the DSA, since for DSA it is the job. But for the bank, the relationship reputation which is built over the years will be at stake if the DSAs fail to perform the expectations professionally. Thus, when we are appointing the DSAs, we have to make sure that we do the background check, the history, how the DSAs have performed. We should also keep an eye on their behavior, how they are approaching the customers. If there are any customer complaints, any grievances, banks should expeditiously deal with those complaints. And if any direct selling agent has a record of proven misconduct, they should not be appointed. All right. So that is the branch and the beyond branch model. Now, banks, for offering their products, also enter into tie ups with institutions, original equipment manufacturers, and dealers, right? So, the tie up with builders, for example, is a preferred financier as the preferred financier for extending home loans. So, here the bank will act as the preferred financier and they will give special concessions like waiver of processing charges, documentation charges, mortgage charges. So banks will approve the specific projects of the builders and express their interest to finance the individual or the group buyers. Builders in turn will refer their buyer customers to the bank. So both the builder as well as the bank will have the benefits. Banks will then follow up with the customers and based on the eligibility, they will sanction the loan. This is one type of tie-up. Another type of tie-up with the builders where the bank will finance the builders for their housing projects and enter into an arrangement with the builders themselves for repaying the loan from the proceeds of sales of the flats to the different buyers. This is another type. Then, tie-ups with auto dealers is another method adopted by banks for expanding the retail credit. And bank tie-ups is a they act as the preferred financer again, and the auto dealer will refer the bank for taking the loan. So when a person visits a tied up car dealer showroom on completion of their choice, the customer is referred to the bank staff at the showroom and the bank staff immediately gets the details and requirements and they start processing the loan, right? So the banks they extend loans to the car dealer against the receivables and adjust the loan from the sanctioned to the individual buyers, right? So dealer can also offer concessions, banks will also offer concessions. This is another type, right? Still, another type of tie-up in this can be a three-party tie-up, wherein the manufacturer, dealer, and the banker will come together for offering loans with maximum concessions. So it is a win-win situation. But mostly, as we see now, banks are not uh, preferring these types of tie-ups with the auto dealers. Mostly the NBFCs are more preferred, right? So banks they tie up with institutions for extending personal loans as well to the group of employees. This is another type, right? And the repayment of loan will be undertaken by the company. The institutions will recover the salary from their employees on a monthly basis and remit it to the bank. Thus, repayment is assured to the bank. All right. Even the education loans are disbursed on a tie-up basis, similar to the auto loan. The banks will set up special counters during the admission session, and when the student is going to get an admission, they will be referred to the bank and they will take the loan. Banks could also garner good number of loans. All right. So this is the tie-up model of banks with the different institutions, original equipment manufacturers and dealers, etc. I hope this topic is clear. Then we also have the co-lending model. So bank RBI has issued guidelines on the co-lending model by banks and NBFCs to the priority sector, agriculture, MSE, weaker sections. As per these guidelines, the primary focus is to improve the flow of credit to the unserved and the underserved sectors of the economy, to make available funds to the ultimate beneficiary at affordable cost. Also, why this co-lending model is preferable? Because banks will offer the lower cost of funds and NBFCs will offer the greater reach. So we will have the benefit of both. Benefit of the lower cost of funds from banks and the greater reach of the NBFCs. All right. So the new scheme is known as the co-lending model, under which the banks are permitted to co-lend with all the RBI registered NBFCs, including the housing finance companies, based on a prior agreement. All right, so what is the objective? To provide to the unserved and underserved segment of the society, of the economy. This will include the semi-urban, rural markets, small business, and the self-employed segment. Now, there are certain requirements or how the co-lending model will work between the bank and the NBFCs. So, who are the eligible counterparties with which the banks can enter into an agreement? All the registered NBFCs, even the housing finance companies. What are the eligible assets? All the loans qualifying for the priority sector advances. What will be the bank's contribution? Minimum 20% by the way of direct exposure. That is, the bank can have a direct exposure of maximum 80%. So 20% will be held by the NBFC and 80% can be held by the bank. But this is the minimum and the maximum. This can also change. 30-70% can be there, 40-60% can be there, but minimum and maximum is given. Not less than 20% to be retained by NBFC and not more than 80% to be retained by the bank. Then, what will be the originator cap or selection criteria? How will the bank select the NBFC for the co-lending model? NBFCs with proven track record, geographical reach, robust credit and collection processes, compatible system capabilities, etc. And the yield will be dependent on the price of the underlying loan for the portion of the bank's contribution to be in line with the applicable regulatory directions. So the banks, they will decide on the yield or the price depending upon the regulatory guidelines given by RBI. All right. So that is about the co-lending model, which is proving to be a good avenue for increasing financial inclusion. All right. And that is all for today. The delivery models, Unit 19, is very important. So make sure that you thoroughly understand each and every topic. If you have any doubt, any query, you can put them down in the comment section. Also, like the video, share the video, and subscribe to the JIB CIB English Medium channel, Oliveboard, so that you do not miss any updates. That is all for today. I will see you again in the next session with more such important topics. Till then, thank you and all the best.